The Dow nearing all-time highs once again, despite a mixed earnings season and a one-of-a-kind presidential election that is getting more wild and more unpredictable by the day.
So what's a long-term investor to do? We'll start by asking one of the greatest value investors of the last few decades, Bob Olstein, the chairman and chief investment officer of Olstein Capital Management. Bob, I want to start right with the political environment and its climate and the future president. Does any of that come into your philosophy for investing?
We just don't listen to the campaign rhetoric of people who want to get elected. We do look at what's going through the government, what's going to become law, and how does it affect the free cash flow of companies, industries that we either own or are looking at. But we can't listen to all of this stuff by politically active people who just want to be elected.
Do you think it's contributed to some of the market's volatility, the fact that you have sort of the more political extremes going on in this election cycle as it relates to the presidency?
The market has just become more volatile over the years. You got 80% of the market now, electronic trading, algorithms, hedge funds who are lost because the spreads aren't there anymore and they want to make money overnight. So the trading has become ridiculous. The analysts are only in as whether somebody has beat the earnings estimates or not. And value players take advantage of that. We have values based on free cash flow, and we let this volatility, we take advantage of it.
So your philosophy is more of a value-based philosophy, working more on the fundamentals, less on the news and the current information that's out there.
There's a difference between an investment decision and a market decision. Investment decision, most analysts today, the general market, they don't really understand there are real companies behind those stocks, okay? And you have to value the businesses. And the values of those businesses do not change as rapid as the stock prices do.
Well, we're going to get into specific companies later in the program in terms of value, what looks attractive, what doesn't. But I want to address two things that you and I have spoken about over the years, and I want the viewers to understand. The first is the difference between buying an index fund and buying an active manager who picks individual stocks. And the second thing is you have a philosophy that you don't want to talk to company management. You don't want to listen to company management. You only want to look at the numbers. And I want viewers to understand that as well. So first, should people be thinking about indexing or should they be thinking about active management, obviously understanding that you're an active manager who has produced outsized results against the index over the years?
Right. I believe it's people's job to find active managers. You have even the governor of Pennsylvania who says there's no risk in the indexes. Well, the indexes were the ones who bought Enron. They bought WorldCom. It's robot investing. All of the money is going to indexing. That's the du jour of the day. Well, they're adding to the PE ratio of Netflix. They're adding to the PE ratio of Amazon. And basically, all that money is going in is creating pockets of overvaluation in some of the stocks in the index.
But the index has beaten something like 95% of active managers since the beginning of quantitative easing in 2009. You don't disagree with that?
I don't look at statistics. I know that we've done pretty well over 20 years. If you put $10,000 in our fund at the inception 20 years ago, today it's worth $69,000. In the S&P with no fees, $50,000.
All right, talk about the idea. Viewers listen. They hear companies, executives come on air, talk about their results. They go to company meetings. They sit down with management. You have always told me you don't want to spend the time doing that. Why not?
Long-term performance. The people who care about individual companies. The long-term performers are the people who make the fewest errors, okay? Right. And it's the magnitude of your error that determines your long-term performance. Everyone's going to pick an IBM or a Google and things like that, but they don't write about the other people who march over the cliffs trying to find it. So basically, if I'm concerned where I can go wrong, after 48 years in this industry, I've never had a management ever tell me or ever say, if you don't vacate my stock, you're going to get burned because we got problems we can't solve. So why would I ask somebody or talk to management? Now, I care about management, but I look behind the numbers, and we're going to talk a lot about looking behind the numbers today and the falsity going on in accounting today.
So let's sum it up for a second, though. Index investing, you buy 500 of the S&P index, and you just buy and hold. Value investing, fundamental investing, you're looking at different stocks either inside that index or outside that index that are fundamentally longer-term attractive than the index. but it's super hard for the average investor to understand that difference. So if you had to sum it up in 30 seconds, what would you say? I
would tell the investors to find people to manage their money, okay, unless they're going to do the work. We create volumes of information on every company we look at, looking behind the numbers. We're going to talk about some of them later, what we find. And if you don't have that ability, then I guess you have to buy the index, but there's no guarantees with the index.
So Bob, you don't want to be in a plane that is being flown by a robot. You actually want a real pilot in the plane.
I want Anthony Scaramucci flying that plane.
All right, you got it. And I'll make sure it lands for you, too.